A child education insurance policy is a life insurance product designed as a saving tool to provide an amount of money when your child reaches the age of entry into a level of education of your choice. Betty Nsima is a mother of 5, including twins. She lost her husband to COVID-19 in 2021. Before Betty's husband died, she was running a child education insurance policy for only the twins, where he made monthly remittances of 200,000 shillings. This was intended to cater for the education of the twins in the future. His agreement with the insurer was to consistently save for 5 years. Sadly, the husband died 2 years into the maturity of the policy. Betty says since the demise of her husband, the insurer has been catering for the education of her twins and will continue to do so.
They told me I still have like 3 years now. If I get now, then next year, and then another year.
According to Portasio Sunday, the Director of Strategy and Marketing Development at the Insurance Regulatory Authority of Uganda, the sector has been growing steadily and life insurance is growing faster than that of non-life.
For life specifically, the growth has been in excess of 25% over the last 10 years.
The industry has gone ahead to introduce innovations such as a child education insurance policy. Sunday gives justification for this.
Education is becoming very expensive. Yes, many are able to afford for as long as they are working. But there are some challenges that happen along the way. One such challenge could be unemployment. You have children, you want to see them through the education cycle, but you don't have a guarantee that you will live to pay their fees throughout the education cycle.
Under the child education insurance policy, a parent saves a certain amount of money with the insurer, either monthly, quarterly or annually for an agreed period of time, say 10 years, or referred to as the policy maturity period. The computation of the monthly savings to be made is actuarial and not mathematical.
We say how much is a first-class school today per term? About 3 million shillings. In a year, that's 9 million shillings. When you add the requirements, maybe another 12 million shillings. If I say from A level, those are 2 years. So 12, that's 24. University, maybe my aspiration is that my child does medicine. And I say by the time the child reaches university, given the current costs, medicine will be costing maybe 5 million shillings, so 7 million shillings per semester. We put that money together and I ask the insurer, how much do I need to pay now per month to ensure that immediately the child finishes senior 4, you take over.
At the maturity of this policy, the insurer takes over the cost of education for the child up to the education level agreed upon. However, the benefits can be reallocated to another child in the event that the child specified in the agreement is not available.
But should you die before the 10 years, again, the insurer will pay at the maturity of the policy. But again, one would wonder who then pays the premiums? Who then pays the commitments made to drive the policy to maturity? The insurance, most of the insurance policies provide a waiver for the premiums, but also some bit of facilitation, if it's an education policy, to ensure that the children are able to continue being in school up to the time the policy matures. And at that time, then it starts paying the promised installments.
The insurer does not recommend paying a lump sum.
Lump sum, you may again, divert this money to other things, and you fail to realize you are.
However, there are also instances where one may become unable to remit monthly savings to the end of the maturity period. The steps to be taken by the insurer in this case depend on the surrender value and surrender period agreed upon.
Now, surrender period is that period where you are expected to pay premiums religiously before the policy can pay back anything. Most policies talk of 3 years. Now, what that means is that if you lose employment in the second year, you have not qualified for surrender value.
There are other options before the insurer may consider closing your file.
Number one, try to look around for people who can help you raise money to pay for the remaining period up to 3 years. The other guidance is that engage your insurer, because these insurers understand.
It is also evident that the policy helps not to burden relatives, but also provides a vehicle to realize your dreams even after death.